Welcome to Wealth Path. We're glad to be with you on this journey to grow wealth and achieve financial freedom together. Today, we're diving into the big news. Donald Trump has won the election. With his return to the White House, we can expect a number of changes that may impact the economy and markets. So, in this video, we'll cover the key sectors that could benefit, potential risks to watch out for, and strategies for positioning your portfolio during a Trump administration. Let's start by examining some policy areas where we may expect changes. A Trump administration could aim to re-implement or expand many of the policies from his first term, particularly in areas like corporate taxes, deregulation, trade, and energy. These areas can impact specific sectors of the economy differently. For example, corporate tax cuts and deregulation could positively affect sectors like finance and big tech, while a focus on tariffs might influence manufacturing and agricultural industries. Energy policy might shift towards greater fossil fuel support, which could be beneficial for oil and gas investors. Let's break down which sectors may see the most benefit under a Trump administration, based on these policy areas. Finance sector. Trump's focus on deregulation is expected to positively impact the financial sector. Deregulation could provide more flexibility for banks and financial firms, allowing them to take on more risk and potentially increase profitability. For example, large banks like JP Morgan and Goldman Sachs could benefit if Trump repeals or reduces certain regulatory requirements. Under Trump's first term, the financial sector benefited from reduced regulations. A renewed push for deregulation could give banks and financial firms more flexibility, which might positively affect their profitability and stock performance. That said, more risk-taking by financial institutions can lead to more volatility, so it's important to weigh the pros and cons. Energy sector. Under Trump's administration, we can anticipate a strong focus on domestic energy production, especially in traditional fossil fuels like oil, gas, and coal. Trump's prior policies favored energy independence, so companies involved in exploration, drilling, and production, such as ExxonMobil and Chevron, could see renewed support. However, keep in mind that while fossil fuels might experience a boost, the global shift toward green energy continues, so balancing investments within the energy sector could be wise. Manufacturing and trade. Trump's trade policies have historically favored American manufacturing, often with tariffs aimed at promoting domestic production. Companies that rely on domestic supply chains or specialize in manufacturing, such as 3M and General Electric, could experience growth if tariffs or incentives encourage companies to reshore their production facilities to the U.S. However, tariffs can also mean higher costs for companies importing materials, so it's worth watching how trade policies develop. Infrastructure was a major focus of Trump's initial term, and he's likely to prioritize it once again. An infrastructure push could mean increased government spending on highways, bridges, and other critical projects, creating opportunities for companies in construction, heavy equipment, and materials supply. Publicly traded companies like Caterpillar Inc., CAT, which manufactures construction machinery, and Vulcan Materials Company, VMC, which supplies construction aggregates, could see growth from such projects. Engineering and project management firms may see a boost too. Now, let's talk tech. Trump's return could have both positive and negative effects on this sector, so it's important to understand the potential challenges and opportunities. Corporate tax reductions could benefit big tech companies by increasing their after-tax earnings. Companies like Apple and Microsoft might see an uptick in profitability, which could drive stock prices higher. However, one of the major concerns for tech under a Trump administration is the potential for increased regulation. Trump has voiced concerns about censorship and anti-competitive practices by large tech platforms like Google, Facebook, and Twitter. For example, Trump previously signed an executive order to limit protections provided by Section 230, a legal provision that shields tech companies from being held liable for user-generated content. Further action on Section 230 could expose tech companies to more regulatory risks and legal challenges. Investors in big tech companies should keep an eye on these developments, as new regulations or changes to liability protections could impact stock valuations. For example, increased scrutiny on privacy practices or antitrust actions could lead to additional costs or operational restrictions for these companies. Political transitions often bring market volatility, especially as investors react to policy changes. During Trump's first term, we saw market swings in response to announcements on tariffs and tax cuts. This time may be no different, particularly with policy uncertainties around trade and tech regulation. One way to navigate this is to keep a balanced portfolio that includes both growth stocks and defensive assets, such as dividend-paying stocks or bonds. Holding income-generating assets can help cushion any short-term market dips. One of the biggest questions for investors in a Trump administration is, what happens to taxes? Trump previously lowered corporate taxes, which boosted many stock valuations. If he proposes similar tax cuts, this could mean more earnings per share for companies, which generally drives stock prices higher. However, on the personal tax front, a Trump administration may focus less on changing capital gains taxes compared to other candidates, potentially benefiting high-net-worth individuals and long-term investors. Lower taxes on investments could mean more attractive after-tax returns for stockholders. It's also important to look globally. During his last term, Trump's trade wars, particularly with China, created uncertainty in global markets. If Trump re-engages in tariff battles, it could lead to headwinds for companies with international exposure, especially tech and manufacturing giants. Given this risk, having exposure to domestic-focused companies or sectors with less international dependency may provide some protection. Or, alternatively, investors could look into international ETFs or funds that spread risk across other global regions. To sum it up, Trump's return to the White House could bring new opportunities and risks for investors. While sectors like infrastructure, finance, energy, and manufacturing may benefit, others like tech may face challenges related to regulation. Maintaining a diversified, balanced portfolio can help you navigate these changes and capitalize on growth where it occurs. Thanks for watching. Be sure to subscribe and hit the bell icon to stay updated on financial news and investment strategies. Drop a comment below if you have any questions, or share how you're planning to invest under this new administration.